A lot of you have been asking really wonderful questions about how to get your loan pre-approval process started, what's most important to consider with a mortgage lender, what about shopping around for mortgages, and how to find the best rate and terms available to you. Scott Jackson is one of our teammates that are subscribed to the channel, and Scott had asked me about what replaced what was called a GFE. Scott, first of all, thank you so much for sending me a great email and asking me such a great question. So for everybody wondering what replaced the GFE, the good faith estimate, the answer in short is the loan estimate. So today's episode, we're going to go over the loan estimate so you know what to look for, and whenever you're out rate shopping, when you're comparing terms of different loan officers, you'll know exactly what you're looking at and where you can go to get more information. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. If you want to be notified of the next episode, please tap the bell icon. Thank you. Okay team, so let's take a closer look at the loan estimate, and before we do, let's go ahead and answer Scott's other couple of questions that he sent me in the email. The first one may be a question that's on your mind as well. Scott shared his concerns with me about the fact that he wasn't renting right now and how he was going to build up his credit score. He said some of his family and friends had told him that if he's not renting, it can actually hurt him in the process of building up a credit score. Scott, fortunately, there's a lot of other ways that you're able to build up a credit score. If you're like Scott and you're wondering of some techniques that you can use to build your credit score, try getting a credit card and paying it off so that you can build up your credit score over time. What will happen by virtue of doing that for 1 to 2 years, you'll start building up a credit score. Another thing is that if you have a vehicle and you're making consistent monthly payments, that'll help you as well. So this really comes into play with multiple options of abilities to increase the credit score and how to build a credit score. For more information about that, check out some of the other episodes that I've made about boosting a credit score and getting your credit score right so that you can go into home buying mode. The second question Scott asked me is it common that home buyers want to test the internet speed and know what the internet speed is whenever looking at homes? Scott, to be honest with you, I've never had that come up before, but it certainly makes a lot of sense, especially in today's hyper-connected age where internet connection and internet speed is incredibly important. So there's something really simple that you can do. Simply go on the Google, type in test my speed, go ahead and run that test right there on the spot, and you'll test your speed. Now just keep in mind, it's going to be off the speed of your internet provider for your phone. So you can know what the speed's going to be on your phone, but it's not going to necessarily indicate what it is on the Wi-Fi. If the sellers are present, or if it's a home that you want to move forward on, simply get with your trusted real estate advisor and ask them to get with the listing agent and ask the seller to perform the same test and report back to you what the upload and download speeds are to see if it's going to match what you need in your home. Okay, so that addresses the other questions that Scott had. So let's go ahead and get into what's going on with this loan estimate and breaking it down. Now, I'm going to put a link down below. Of course, I'm going to make this easy for you of where to go so that you can look at the same thing that I'm looking at. So I'm going to go ahead and pop it up on the screen and we can start taking a look at this. This information is coming from the Consumer Financial Protection Bureau, which is known as the CFPB. Their website is consumerfinance.gov. Let's take a closer look at the loan estimate. On your screen, you'll see what the loan estimate looks like. Now, whenever you're on the consumerfinance.gov site, looking at this loan estimate, they've made it very, very helpful with the ability to click on various fields and show you on the right-hand side and explain more and give you a link to additional information if you have questions. The other really cool thing they've done is if you need the definitions for the different terms used in the loan estimate, they put it on the right-hand side right here underneath Get Definitions. You can easily click back and forth on the top here. So let's go ahead and go back to check details and get into the details of the loan estimate. The first thing that we want to take note of on the loan estimate is to make sure that your name is spelled correctly and that all applicants on the loan are actually there, along with the address. The second thing that we want to take a look at is your loan terms, and we want to know what the purpose of the loan is. If you're refinancing a property, then it'll say refinance here. If you're purchasing your home, it's going to simply say purchase. We want to know what kind of product that you're getting with your loan. Is it a fixed rate? Is it a variable rate? Is it an adjustable rate mortgage? It'll say right here, along with the loan type right below it, conventional, FHA, VA, and this box here could probably go with USDA, right? Then we want to know what the rate lock is looking like. Is it a rate lock? If it was a rate lock, how long is your rate lock good for, and what are the terms of the rate lock? Down here, you go into the loan terms. Notice the heading right here, easy to follow along. Now we're into loan terms. What was the loan amount, and can this amount increase after closing? No. What's the interest rate? Can this amount increase after closing? No. What is the total of the amount based upon the subject loan? It's $761.78 in this case, and can this amount increase after closing? No. Prepayment penalty. Now this is extremely important to ask your loan officer that you choose to go forward with. You want to make sure that any loan type that you get does not, and I repeat, does not have a prepayment penalty. The reason being is simple. Whenever you're looking for different ways to pay off a mortgage quicker, you can actually do so by simply depositing an additional $100 a month if it's within your financial capabilities to do so onto the principal balance of your loan. By just doing that, you can save yourself anywhere between 3 years and 5 years over the length and the lifetime of your loan. Something helpful to know, so you want to make sure that you're not going to have a prepayment penalty. You also would like to know if you're going to have a balloon payment. They're very, very risky. Please stay away from them. Then you want to get underneath the projected payments. Underneath your projected payments, it's going to show you over the next 30 years what your projected payments are in between years 1 and 7 and years 8 through 30. And from the principal and interest on the left-hand side down to your mortgage insurance. Now notice underneath years 1 through 7, you actually have a mortgage insurance of $82 on an estimated basis. Now underneath years 8 through 30, it went away. Why was that? Well, if you'll recall, we're talking about a conventional loan. A conventional loan is going to have a private mortgage insurance on the loan until you reach what's called 20% loan to value ratio. So in other words, if you put 10% down on your conventional loan, then you only need to accrue another 10% of equity that can be done by a market appreciation or by paying off 10% more of your loan. When you reach that point, you will drop your private mortgage insurance. Now, please don't confuse this with mortgage insurance premium, which applies to FHA loans. I'll go ahead and make a card available if you guys have questions about that. Click the card where I've broken it down, the difference in between both of those. Now you'll notice this section where it says estimated escrow, and you'll notice it says amount can increase over time. Now you might be wondering, why could the amount increase over time? The first thing that comes to mind are property taxes. As your home appreciates over time, your county is going to reassess your property taxes. If it's finding that your property is becoming worth more and more money, it's likely that your property and taxes will also increase based upon their evaluation of your property. It's pretty simple to find your property tax rate in your county. Go to the website, go to your county assessor's website and see what your property tax rate is, or simply Google it. What is the property tax rate in Las Vegas, Nevada, for example, right? Plug and play as it is appropriate for you. So the next thing that we come into is estimated taxes, insurance, and assessments. Again, amount can increase over time. This estimate includes property taxes. Is it an escrow? Yes. Homeowner's insurance? Yes. That's another reason why this could increase is if you change the type of coverage that you have for your homeowner's insurance. Now, lastly, here on the first page, we have cost at closing. It shows your estimated closing costs, which includes this $5,672 in loan costs and $2,382 in other costs for this example. And it says what? See page 2 for details. Estimated cash to close. So this is a total amount of money that you're going to need to be able to close on your new home. Include your closing costs, and then it says see calculating cash to close on page 2 for details. Which brings us full circle into now going into page 2. On page 2, it gives us the closing cost details, and it breaks everything down line by line, beginning with their origination charges. Each lender may have a different amount of money that they charge for their loan origination. In this case, as you recall from page 1, they had said that there were some points purchased. In this case, 1/4% of the loan amount of points was purchased for $405. Then there's the application fee, the underwriting fee. Then you move down to section B where it says services you cannot shop for, being the appraisal fee, a credit report fee, flood determination fee where applicable, flood monitoring fee, again where applicable, tax monitoring fee, and tax status research fee. So then you move down to section C, and then you notice that it says services you can shop for. Now we're looking specifically here of the services you can shop for being your pest inspection fee, your survey fee, your insurance binder, your lender's title policy, settlement agent fee, and your title search. The total of those numbers amount to $3,198. Then you move down to D, where it says total loan costs A, B, and C, and this is the total amount that underneath this column here is what you're going to be paying for your new home loan. Then you move back to the right-hand side column on the top where it says other costs to look at the breakdown of the further fees. Well, let's lead off with letter E. Taxes and other government fees here are estimated at $85. Recording fees and other taxes and transfer taxes are estimated at $85. Then you'll notice that you have an opportunity to have prepaids. For prepaids, they have homeowner's insurance premium. Now notice that this is actually for a full 6 months of prepaids for your homeowner's insurance. Then you have the mortgage insurance premium. In this case, it didn't have a mortgage insurance premium. This is a conventional loan, so it's a private mortgage insurance. Then you have prepaid interest, and it gives you the per diem rate, which is simply means per day rate for 15 days at this amount for the percent, and this is how the prepaid interest is calculated. Then you have property taxes. Now, underneath letter G, you have initial escrow payment at closing of $413. Again, we're talking about the homeowner's insurance premium. It'll break it down by month for the first 2 months. months. So also, you're, in addition to your homeowner's insurance premium being prepaid for 6 months, you also have your homeowner's insurance being paid at closing for 2 months. Then you have your mortgage insurance. Then you have property taxes. Property and taxes here are being held in advance for 2 months. Then you move into letter H, where it shows that title and owner's title policy is optional. It is wise to have an owner's title policy. At the same time, it is optional if you only want a normal title policy. Then you go to letter I, where it's the total of other costs, adding up line items E, F, G, and H for this total amount of $2,382 in this example. Then you move down to letter J, where it shows the total closing costs. Now, total closing costs were added by going from line item D and adding it up with line item I. Both of those combined come to this amount here of $8,054 for this example. And you come up with another highlighted column about lender credits and explaining more about how lender credits work and what they are. Then you go into the calculating cash to close function here. Now, total closing costs are $8,054. Closing cost finance, in other words, paid from your loan amount, are zero in this example. Your down payment and funds from the borrower due are $18,000. There was an initial escrow deposit of $10,000, which is reflected here with a negative $10,000. Then you have funds for borrower, zero, seller credits were zero, and adjustments and other credits were zero, bringing the total estimated cash to close to $16,054 for this example. The next section that we take a look at is the third page. Now, this is additional information about the loan that you're getting, in specific, this loan with this loan officer. And it has another highlightable field here for the loan officer. Now, on the right-hand side, I do want you to pay attention to this and note that most loan officers are required to be licensed or registered with a nationwide mortgage licensing system and registry. Hence, when you see NMLS next to your lender's name, that is their actual license number. If you want to look them up, you can go to NMLS database by simply clicking the hyperlink here on this web page. Now you move into comparisons, and it says use these measures to compare this loan with other loans. In 5 years, it shares with you that you'd have $56,582 to be the total you will have paid in principal, interest, mortgage insurance, and loan costs, with $15,773 of your principal you would have paid off in the first 5 years. It shows the annual percentage rate in this example at 4.274%, which is your cost of the loan term expressed as the rate. This is not your interest rate. Then you have the total interest percentage, TIP, at 69.45%. Now, this is the total amount of interest that you will pay over the loan term as a percentage of your loan amount. So if you're wondering, how does it go from a 4.274% to a 69.45%, it's sharing with you that this top number here, this $56,582, is what you paid towards your principal, interest, mortgage insurance, and loan costs, yet only $15,773 of that went to the principal that you've actually paid off. When they start doing the calculations on that, that comes out to roughly 69.45% interest that you have paid at that point in the life of the loan. Then you move into other considerations. It goes into appraisals, assumptions, homeowner's insurance, late payment. In other words, what is the grace period if you're not making your loan payment on time, which ideally the easiest way to do that is when your mortgage is set up with the mortgage service provider, just set up an auto deduct and pull out the mortgage amount on the first of every month, and you'll never have to worry about not paying your mortgage. It'll always be paid for you. If in this case this person was delinquent, they had up to 15 days to be late, or they'd be charged 5% of the monthly principal and interest payment. Then you move into the refinance section, where it says refinancing this loan will depend on your future financial situation, the property value, market conditions, and that you may not be able to refinance this loan depending on your financial circumstances at that future point in time. And then you go into the servicing portion, where it says the lender intends to either service your loan, and if so, you'll make the payments directly to the lender, or they intend to transfer servicing of your loan. Now, transferring service of your loan is just a really nice way of saying they're about to sell your mortgage note to somebody else. It could be US Bank, Wells Fargo, Chase, or any number of other mortgage service providers that could be purchasing your mortgage note. Now, in a lot of the videos that I've made, I do share with you that it would be ideal if your local loan officer can service your own loan within their own financial institution. You might want to discuss that with them and make it one of your qualification questions whenever it comes time to choosing the right local loan officer for you to work with. To find out more information about how the loan estimate is going to impact you, please reach out to a local loan officer to review your financial situation with you and the home loan products that are going to be available for you. The CFPB does have additional resources available to you about buying a home. Feel free to go ahead and sign up in the section that I'm showing you on the screen now, and it's very simple to do, and stay in tune with the information they can help you with consumer finance, and specific your finance. We have covered a lot of information information in today's loan estimate explainer video. I hope you've taken a lot out of this that you can use right away and put into use whenever you go out shopping for your home loan. Now, here's what I'd like you to do. Tell me what you took away from this video in the comment section below and share your helpful tips about the loan estimate and the home buying process with us in the comment section below. Now I'm going to go ahead and pop up my contact information. If you simply wanted to reach out to me to say hello, or if you need help finding a top agent where you live, please let me know. Always love to hear from you, and I'm always here to help. If you haven't already done so, I'm going to ask you to do 3 things. Number 1, please subscribe to this channel. Number 2, please like this video. Number 3, please share this video around with someone you know is going to be able to help, because someone just like you right now, and I'm sure you could think of one, is just like you, wondering about what's going on with a loan estimate and how would they know if they're getting the right local loan officer to help them or not. Please share this episode with them. It'll really help them out. In between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. Thank you for watching today, team, and enjoy an amazing day.